Today, I have two interesting stories for you. In the first one, I talk about Manipal's IPO, and in the second one, I talk about why manufacturing has started to look like services. You see, hospitals are a strange business. We don't visit them because we want to. We visit them because we have to. When a family member is critically ill, you don't ask the receptionist for a price list or compare rates across different hospitals on your phone. You simply hand over your credit card. That urgency exists because access to quality hospital beds can make all the difference. And India doesn't have enough of them. The country has just 16 hospital beds for every 10,000 people. The global average is almost double at nearly 30. Even Vietnam has more hospital beds per person than India. Now, India does have a vast public healthcare system with government hospitals spread across the country. But that doesn't reduce the need for a strong private healthcare system to share the burden of caring for our population. Now, that's where large private hospital chains come in. Several are already listed and another is on its way to the stock market. We're talking about Manipal Health, whose 97 crore IPO closes for subscription today. So if you're planning to apply or you're simply curious about how the hospital business works, this story is for you. A hospital's business can broadly be split into two parts, the outpatient department or OPD and the inpatient department or IPD. While both treat patients, they operate like two very different businesses. The OPD is where patients come for routine consultations, blood tests, x-rays or other minor procedures before heading home the same day. Naturally, this department sees a lot of footfall, but despite the high volume, it isn't very profitable. That's because most OPD treatments aren't specialized enough to command high prices while the costs are substantial. Hospitals need to maintain clinics, hire large administrative teams to manage patient flow, and pay doctors to be available throughout the day. Now at the same time, the DRHP points out that hospitals have very little pricing power here. Charge too much for an OPD consultation or diagnostic test and patients can simply walk across the street to a standalone clinic or lab because the competition is too fragmented. The inpatient department or IPD is a completely different story. This is where patients are admitted overnight for surgeries, intensive care or longer treatments. It's also where hospitals make most of their money. Now around 70% of hospital revenue comes from IPD services and this segment is growing much faster than OPD. Now the reason is pretty simple. Once a patient is admitted, every part of the treatment becomes billable. Hospitals charge for room rent, nursing care, operating theatre time, anesthesia, diagnostic scans, and they can also earn from drugs, implants and consumables such as stents. More importantly, inpatient admissions are often driven by emergencies or serious medical conditions. Now at that point, the priority is getting the treatment right, not comparing prices. Now that gives hospitals far greater pricing power than they enjoy in the OPD. Now coming back to Manipal. Like most hospital chains, it doesn't run its OPD to make money on a standalone basis. Instead, the OPD acts as a funnel into the much more profitable IPD. For instance, a doctor may diagnose a complex condition during an OPD consultation and schedule a surgery. What began as a low-ticket outpatient visit can turn into a high-value inpatient admission. Once a patient enters the IPD, Manipal further optimizes its economics in two ways. First, it avoids filling expensive hospital beds with patients who only need basic monitoring. Instead, it focuses on 6 high-value specialties. Now, these 6 specialties account for roughly 60% of Manipal's inpatient revenue. They also tend to involve more complex procedures that command higher margins. More importantly, this share has been steadily increasing over the past 2 years. Second, a hospital bed costs almost the same to maintain whether someone is using it or not. The lights stay on, the room needs cleaning, and the staff still has to be paid. So the goal isn't just to keep the beds occupied throughout the year. It's also to free them up quickly for the next patient. Now the DRHP offers an interesting insight here. A patient typically generates the highest revenue during the first 48 hours of admission. Now that's when surgeries happen, expensive medicines are administered, and most diagnostic procedures are carried out. If the same patient stays for another week, they continue occupying a bed but contribute relatively little additional revenue. In other words, a longer stay isn't necessarily better for the hospital. It's far more efficient to treat the patient well and discharge them as soon as they're medically fit. Now that likely explains why Manipal has one of the shortest average length of stay in the industry. On average, patients are discharged in under 3 days. Now this also helps us explain another important metric, which is average revenue per occupied bed. Manipal earns around 69,000 per occupied bed each day. While that's among the lower figures in the industry, it also reflects its faster patient turnover. Simply put, Manipal may earn less from each bed on any given day, but by treating and discharging patients faster, it can serve more patients with the same number of beds. But running a clinical machine does not guarantee easy cash. That's because hospitals don't always get paid the same way. Manipal collects its revenue through three distinct channels. The ideal scenario is when patients pay the bill themselves before discharge. The hospital gets its money immediately with no middlemen and no discounts. Naturally, this is the most profitable channel. But since FY24, its share has been declining as insurance and government-backed payments have grown. The second channel is insurance. Here, the patient doesn't pay, the insurance company does. Now that's a little bit more complicated. As insurance penetration has increased, insurers now represent thousands of patients. That gives them the bargaining power to negotiate steep discounts, often 10 to 20% below standard rates, something an individual patient could never do. They also don't pay immediately. Hospitals often wait 45 to 60 days before the money arrives. There is another problem here though. Sometimes the money never arrives at all. If an insurer rejects a claim after the surgery has already been performed, the hospital may have to absorb the loss. Manipal wrote off around 78 crores of bad debts in FY26 after an even larger write-off of roughly 119 crores in FY25. Now the third channel is government schemes such as Ayushman Bharat. Here, hospitals treat eligible patients and are later reimbursed by the government. This helps keep hospital capacity occupied, but it comes with its own challenges. The biggest issue is pricing. A private patient might pay close to 3 lakh rupees for a heart bypass surgery. Under a government scheme, reimbursement for the same procedure may be capped at around 90,000 rupees. Now at those rates, the hospital may barely recover the cost of surgery, medicines and consumables. On top of that, reimbursements are often delayed. As a result, Manipal has a significant amount of money tied up in claims that are still awaiting government approval, putting pressure on its day-to-day cash flows. Now in the end, running a hospital is a constant balancing act. Cash-paying patients are the most attractive because they pay the full amount immediately, but they no longer account for the bulk of admissions. To keep beds occupied, hospitals also need insurance and government patients. The trade-off is lower prices, longer payment cycles, and a higher risk of delayed or disputed payments. Now, managing that mix is a critical part of the business. Now, if Manipal has built such an efficient operating machine, you'd expect it to be highly profitable. But once a patient leaves, a different battle begins, getting paid while keeping costs under control. The company is caught in a constant squeeze. On one side are star doctors demanding a larger share of the economics, on the other are insurance companies pushing for deeper discounts. The result is that hospital margins remain tighter than you might expect. The biggest cost, of course, is doctors. In India, patients are often more loyal to their surgeon, not the hospital brand. If a star doctor leaves, many patients leave with them. That gives leading doctors enormous bargaining power. Hospitals typically compensate them with a share of revenue generated from consultations, tests, and surgeries. In FY26 alone, Manipal paid roughly 2,300 crores in professional fees to doctors, which is about 23% of its operating revenue. It's a cost management can't easily reduce without risking patient volumes. Nurses, administrative staff, support staff, and senior management are accounted for separately under employee benefit expenses. Manipal's EBITDA margin has steadily declined from 27.5% in FY24 to 25.6% in FY26. Interestingly, this wasn't because medicines or medical supplies became significantly more expensive. Those costs remain relatively stable. The bigger drag came from rising payouts to doctors. Now that also explains why hospitals rarely rely on margin expansion alone to grow. If you can't extract much more profit from each bed, the obvious answer is to add more beds. The problem is that building a premium hospital is painfully slow. It can take 3 to 5 years to construct one, followed by another 3 years before it reaches break-even. Acquiring an existing hospital is much faster. Now that's exactly the route Manipal chose. Between FY21 and FY26, the company went on an aggressive acquisition spree. During those 5 years, it added about 6,000 beds in total. Of these, around 5,500 came through acquisitions rather than new construction. Alongside Aster, Manipal has been one of industry's most aggressive consolidators. Now, of course, acquisitions only create value if you buy the right assets at the right price and integrate them well. Manipal paid premium valuations for many of these hospitals. That has left its balance sheet carrying a large amount of goodwill, an accounting asset that represents the premium paid above the value of the acquired buildings, equipments, and other tangible assets. Today, Manipal has around 8,100 crores of goodwill on its balance sheet, almost 3 times what it carried 2 years ago. Now, goodwill isn't inherently bad. It simply reflects what a buyer believes the acquired business will be worth in the future. But if those expectations don't materialize, the company has to write down the goodwill and recognize the loss. That's exactly what happened in FY24. After the HealthMap Diagnostics acquisition underperformed because of delayed payments and unprofitable pricing, Manipal wrote off 114 crores of goodwill. For context, the company had originally recorded about 305 crores of goodwill from that acquisition. In other words, nearly 40% of the premium had to be raised. Whether the current goodwill on Manipal's balance sheet is justified is ultimately for investors to judge. Now, coming back to the IPO itself, one thing stands out. This 9,700 crore issue isn't really about building new hospitals, setting up clinics, or buying cutting-edge medical equipment. Instead, it's largely about cleaning up the balance sheet after Manipal's acquisition spree that we talked about earlier. The biggest example is Sahyadri Hospitals. When Manipal acquired Sahyadri, it financed the deal by issuing non-convertible debentures, carrying an interest rate of about 9%. Now that pushed total borrowings to nearly 10,500 crores and drove interest cost up 69% in FY26. Now this IPO is largely meant to unwind that financing. Around 5,500 crores, which is nearly 70% of the fresh issue, will be used to repay the debt taken on for the Sahyadri acquisition. Another 574 crores will be used to buy out the remaining minority shareholders in Sahyadri. In simple terms, Manipal first bought a competitor using borrowed money. It is now using IPO proceeds to replace that expensive debt with equity capital. Repaying the Sahyadri debt will reduce Manipal's borrowings by almost half. The company won't become debt-free, but its leverage will move much more closer to peers like Apollo and Fortis. Alongside the fresh issue, existing shareholders are also selling part of their stake through offer for sale. Now, Manipal knows how to run hospitals. It fills beds, turns them over quickly, and focuses on the procedures that make the most money. The IPO, however, isn't really about expanding that business. It's largely about paying down debt from past acquisitions. That will improve the balance sheet and free up cash for future growth. So the question isn't whether Manipal is a good hospital operator. It's whether you're comfortable paying today for growth it has already bought and might continue buying in the future. Now, coming to the second story. Last August, Prime Minister Narendra Modi flagged off a car in Gujarat, Maruti Suzuki's e-VITARA. Now, the car was built exclusively at the company's Gujarat plant. From there, it shall be exported to more than 100 countries from the United Kingdom to Japan. According to Maruti, it is slated to become the largest mass-produced electric vehicle exported out of India. Now, for all that, it isn't an Indian car though. It runs on a platform Suzuki developed. Both the global product and the brand belong to a Japanese company. There's also a little bit of tension here. In some ways, the e-VITARA is made in India. The plant, the workers, much of the supply base, the crash testing, the logistics, the domestic service network, everything physical and concrete sits in India. Suzuki controls the rights over the platform, the global product, and the brand. But it isn't clear who the engineering can be attributed to, at least from the public disclosures. Chances are some of it happened in Japan, some at Suzuki's Indian R&D operation, and some within Maruti itself. So whose car is it then? It is tempting to claim simply that this is a Japanese car manufactured in India, but that isn't true. Ultimately, the car was not simply designed in Japan. The manufacturing happening in India can't be untangled from the services around it that India provides. The line between the two is blurred. The car is at once Indian and Japanese. Now, this is an emblematic of a shift economists call the servification of manufacturing. Now, modern industry is a terribly complex thing. Rarely is a modern car, phone, or machine made in one place. There's a massive bundle of tasks that go into making one, and more often than not, these are pulled apart and outsourced to a range of suppliers. A company could design a widget in one country, then source components for it from a dozen countries scattered around the world, and assemble it in a country that offers cheap labor and service it from an entirely different location. Of course, manufacturers have been buying components from other countries for ages. What's new, however, is that an increasing part of making something revolves around purchasing services, where you would once coordinate with different factories to buy supplies like gaskets or ball bearings. Companies now coordinate with new types of entities like laboratories, engineering teams, or service networks. Now, this elaborate dance, what is called a global value chain, can all be coordinated at scale today because the designs are often modular, different suppliers have common technical standards, and digital coordination is easy and cheap. Now, this marks a genuine evolution of how manufacturing happens. With these advancements, smaller tasks which would serve as support functions within a company could be separated out. The software that decides how a machine works, the testing and certification necessary to export, data collection to iteratively develop the next model, all of these now are treated as distinct parts of production and are optimized in themselves. Economists call this servification. These services fit into different parts of the value chain. Some services are proprietary, they shape the very product itself. Think of the core technology underneath a product, the industrial design that shapes it, the software that helps it run, or the branding that ties it all. These are all fundamental to a product. They determine what it is and how it behaves. If you have control over these, in a sense, you own the product. Other services, in contrast, are operational. Think of the testing necessary to catch defects or the supplier development teams that help component makers meet the standards, the logistics that keep the parts moving, or maintenance and after-sale services that keeps the thing running. These might not shape the product, but they decide whether the product and business around it runs smoothly. Now, according to OECD, 37% of the value of manufacturing exports in the countries it studied were actually services like these. Add service-like functions within a manufacturing setup like engineers, planners, or IT staff, and that share reaches 53%. If you include value-added services, it rises higher still. Now, picture two factories. One imports components and simply bolts them together. The other does more. It adds a services layer on top. It adapts its product to local conditions, tests components, helps its supplier network pass a foreign buyer's audit, runs production software, diagnoses failures, and feeds its learning into the next iteration. Now, in the beginning, both their outputs might look exactly the same, but over time, they're likely to diverge. Chances are the first remains a replaceable assembly site which can be easily swapped out for another. The second factory, meanwhile, runs a continuous learning loop. It might cut defects and development time over production runs. Its suppliers could slowly qualify for bigger contracts. It could learn what breaks after a sale and develop valuable insights on what subsequent production runs must fix. This sort of a factory, within the knowledge it has built up, is far harder to replace. In other words, services aren't separated from manufacturing. In fact, they help build manufacturing capacity itself, giving a factory stickiness in global value chains. There's clear evidence for how much the output of a factory floor depends on non-physical factors. The Economist, for instance, looked at what happened when India opened up industries like banking, telecoms, insurance, and transport in the 1990s and 2000s. As they found, manufacturers that depended most on these sectors grew 12% more productive. Similarly, in another study, Economist found that when Indian textile plants introduced basic systems for quality control, inventory, and delegation, their productivity went up by 17% in a single year. There's one complication, however. Sometimes, as the Economist found, manufacturers don't take on services to become stronger. They may do so because competitors are eating into their core production work and they're falling back on services in order to just survive. Imagine a phone manufacturer that gets overwhelmed by Chinese imports. They might diversify into repair work to survive. On paper, this might make it look more service heavy. But that doesn't mean the company is growing more sophisticated, just that it's keeping its head above water. Now, with this framework in mind, what does India's manufacturing sector look like? To what extent are services wrapped within it, and what services do we perform? Let's start with smartphones. According to Anirudh Singhal from CSEP, of the manufacturing sectors he has seen, the computers and electronics we make carry the highest share of domestic services. Over a quarter of their export value comes from services work. While India's electronic manufacturing sector is often derided as simply doing low value assembly, these operations are building genuine capacity and things like process engineering, testing, supplier management, which shall compound over time. That said, the proprietary services embedded in those products, brands, architects, operating systems usually remain with foreign companies. We've come further along with automobiles. Over decades, India has built dense networks around vehicle manufacturing. India has an auto component industry worth over $80 billion in FY25 with exports worth $22.9 billion. Cars also come along with a spare repair and spare parts economy. Maruti alone, for instance, saw almost 3 crore service visits last year. This domestic aftermarket in itself is worth $11.8 billion, a huge service economy in its own right. Now, this has given India a large base of engineers, suppliers, and dealers, and a great deal of operating know how. Now, that said, we don't yet own the slice of services that gives us ownership. It isn't Maruti, but the Japanese parent Suzuki that owns the platforms its cars are built on, as well as their architect and brand. The e-VITARA needs India and depends on a substantial manufacturing and services ecosystem, but it is a Japanese firm that controls the car. When policymakers think of manufacturing and services, they see two separate worlds. Factories receive one set of incentives and are governed by one set of laws. Services, software, testing, logistics, and engineering seem to sit in different buckets altogether. Modern products, however, don't divide themselves so neatly. If we intend to reach Atmanirbharta in manufacturing, we can't afford to live by these false binaries. We need to look at everything at once. The competitiveness of our factories might be determined by things happening outside the factory gate. From the health of our testing laboratories to restrictions on logistics and warehousing to the availability of trained technicians. By the same token, it is foolish to congratulate ourselves merely when a product is made in India. It makes more sense to ask whether that production has taken root here through the wider network around the factory floor and how much control we actually have. If modern industry no longer stops at the factory gate, neither should industrial policy. Now coming to the tidbits. To address growing consumer complaints about inflated electricity bills following smart meter installations, the government is introducing rules that allow consumers to challenge meter accuracy. The electric passenger vehicle market in India is seeing increased competition as new players start to establish a strong foothold. In the first half of the calendar year 2026, companies like Maruti Suzuki, VinFast and Tesla captured an 8.1% market share of the segment, driving 18% of the incremental vehicle registrations. India's cotton exports are projected to jump to record 60 lakh sales this season as the domestic textile industry seeks cheaper raw materials from overseas. With ongoing attacks in the Black Sea delaying sunflower oil shipments from the top suppliers, Russia and Ukraine by up to 60 days, India is scrambling to secure alternatives. Despite record high electricity demand this summer, India lost roughly 11% of its generated solar power. This massive energy loss is primarily due to severe bottlenecks in the national grid's transmission infrastructure, which lacks the capacity to effectively store or transport the surge in renewable energy. That's it for this episode. See you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.